Welcome everyone to the 2015 Halftime Report. I'm Adam Koos, President and Portfolio Manager at Libertas Wealth Management Group in Columbus, Ohio. I'm really excited today because this is our first ever educational video, with the exception of a little snippet we did earlier this year on how to find a trustworthy financial advisor. To our clients and friends who are used to me writing a weekly market commentary every week, I apologize for the lull this past week as I put this video together. It's taken quite a bit of time. If you're not receiving our weekly written commentary, then please contact our office via our website at www.libertaswealth.com. You can email us, call us, anything you want to make sure you're on the list. So this first ever halftime video was recorded on Thursday, July 24th, but I put together the charts, tables, graphs, and annotations the morning of Wednesday, July 23rd, just so you know, for the sake of market prices as we go through the presentation. It'll be fun to one day refer back to this video and reflect on what the summer of 2015 felt like at the time and how things actually turned out, for better or for worse. So let's go ahead and get started. First of all, I just want to make sure you optimize your viewing experience. You can click on the box right here to increase the size of your screen to a larger viewing area. If you click on the open bracket to the right in the corner, right over here, you can view this presentation in full screen. Also, if you click on the gear button with the HD symbol, which is found right there, you can choose a higher resolution. All these options will make it easier to view the charts and other information I'm going to show you today. So let's go over today's agenda really quick. First, we're going to discuss some current events, Greece, China, interest rates. We'll have a little state of the market address and discuss what's going on in the market today, and then we'll talk about where the market could go from here before closing out and offering some details on how you can get additional information and education from us. So let's go ahead and get started. First of all, current events. So China, in my opinion, economic data has improved here, but stocks continue to be declined due to a lot of emotional jitters. 2 Fridays ago, Janet Yellen ignored both Greece and China in her statements, so I'm not so sure that if the Fed's concerned either. We are extremely oversold at this point, although China has done a little bit of rebounding, has bounced a little bit, but we are pretty oversold, so I think that at this point, the worst could be behind us when it comes to China. Greece, on the other hand, if you remember back in 2011, there was pretty much the same thing going on then that's going on now. So think of it like deja vu. I mean, most of the worry, again, is, I think, behind us, much like the case with China. But at the same time, regardless of how much money the Eurozone finance ministers are willing to give, I think it'll be Greece that we see in the news again someday, just like we did back in 2011. So they just keep kicking the can down the road here, and I don't anticipate that it's going to go away anytime soon. As far as interest rates go here in the United States, we've been hearing people talk about interest rates all the way back to Ben Bernanke, and they keep saying rates are going to go up, that they promised it's going to go up, then they think it's going to go up, and at this point, what we're seeing is some Fed officials saying that maybe September. We've heard some say that maybe year end. We've also had some people say that maybe next year. So we don't really know. No one knows when rates are actually going to go up, but like all noise, the majority of this news will likely be priced into the market before the news hits. This is why we at our office observe and focus on charts, not news. News is noise. Looking at interest rates, not the Fed funds rate that Washington controls, but the 30-year Treasury, which is a good benchmark for observing and studying rates. Interest rates have been going up since April, as you can see on this point and figure chart above. The breakout occurred in late April, actually, and the 30-year Treasury has been rising since. I don't know how many of you remember what you were paying on your mortgage back in the 1980s, or what you were getting on your CDs or savings accounts at the bank back then, but if you don't remember, you were getting rates that were a whole lot better than you're getting now. To most of you, this won't be breaking news, obviously. When you consider the fact that we've lived through a 30-year bull market in bonds, when rates go down, remember, bonds go up, and when interest rates go up, bond prices go down. What we're seeing today could be, and I do think we've probably seen the bottom in interest rates, at least for the next several years. Again, just on the chart, looking at interest rates again, Bottom line here, again, rates are already going up, but the trend reversal took place back in April, and we've seen further evidence confirming that trend. Again, the point and figure breakout occurred right about here on the previous chart we looked at, and then we see higher highs as time's gone on and some higher lows as well. So let's change gears again and start talking about market pulse and vital statistics of the market. Back in the 1970s, RS charts, or in other words, relative strength charts, were actually done by hand. It would take a week to put together a relative strength chart or matrix, which is, if you didn't know what relative strength is, it's like comparing one investment to another in a really objective manner. So you can compare one investment to another. You can compare investment to one investment to a basket of investments. You can compare an investment to the market. You can pick any index out of the sky that you want. So when we look at these asset classes above here on the screen, we're comparing all the investments in all the industry groups and all the sectors of the market universe to determine which asset classes are best to own. In this case, domestic stocks, international equities are at the top. They're the best two asset classes to own right now, with domestic equities being the number one asset class. Try to think of it like any ranking system you'd see in sports, like golf, football, or whatever. The more wins that each asset class gets, the better the ranking. So if U.S. stocks are winning more games versus international stocks, then the ranking would be higher for U.S. stocks like it is today. Andy Barton at our office, our senior financial advisor, he likes to use the analogy of fair weather fans. So we put our money on the top 2 to 3 teams, in this case asset classes, and we own them until the rankings change. Then when the team falls out of favor, or in other words, when the investment falls out of favor, we strategically shift the weighting of our models to the new, strengthening investments that are gaining traction and momentum, trimming and eventually eliminating our holdings in the past winners that are weakening. So again, kind of like being a fair weather fan, my Cleveland Browns are horrible, and hopefully someday they'll win a playoff game, let alone a Super Bowl. But similarly, Kentucky is always a great basketball team, but in 2013, they didn't even make the NCAA tournament. So the way to look at the market today is a lot like being a fair weather fan, and for now, domestic stocks are solidly in the number 1 spot, with international at number 2 and fixed income, or in other words, bonds, right behind them. There are way too many indicators that one can follow to track trends and investments in the markets, and as a result, this could turn into a 60-minute video easily, but we obviously don't want to lose anyone here if we haven't already. When you take a trend following and you add relative strength into the mix, things get even more complicated. When you start overlaying ADX lines, MACD, stochastic indicators, then everyone goes narcoleptic on me. So we like to talk about 5 main flags to watch out for. And since we call our portfolio management strategy defense first, we've chosen to forego the cliche of red flags and instead opt for penalty flags. So we thank you in advance for playing along. First, if the market is starting to crash, one of the signs that we would observe is seeing defensive asset classes showing momentum and strength superior to that of offensive asset classes. Let's look at that first one here. Again, at the top here, defensive asset classes giving relative strength buy signals over offensive asset classes. Right now, like I mentioned earlier, there's our little brackets at the bottom. U.S. stocks and international stocks are where we're focusing our holdings. In our more conservative portfolios, we still own some bonds, but even then we're still focused on a higher weighting on domestic and international stocks because that's where the momentum and trends are. It can be frustrating sometimes to own investments that are struggling, but this last few years has shown and continues to show us that U.S. stocks are the place to be. Just one more statistic about college basketball that's very significant to what we're talking about here. All the winners, of all the winners of the March Madness tournaments, ESPN reports that over 80% of those winners have been number 1 ranked teams. So there are 4 number 1 ranked teams every year. So this is similar to the picture we're looking at above. If we focus our money on those top-ranked asset classes, the idea is that we'll win most of the time. And as a side note, just for fun, never in history has a 16th-ranked team won the tournament ever. So it just kind of makes the case for staying away from lower-ranked asset classes, like in this case, commodities or even currencies. Just another note on bonds, we have to be careful here as interest rates rise, because again, bond prices fall when rates go up. If you're a moderate, balanced, or conservative investor, it's absolutely crucial that you have your portfolio evaluated soon in order to ensure you're protected from the not-so-good subsectors in the bond market. If you don't pay attention to the bonds in your portfolio, you can find yourself losing money in what most people have traditionally considered a safe investment. Again, people think bonds, they think safe. Just this year, for instance, bonds are down 1.1%, but most people probably haven't even noticed. As interest rates continue to go up from here, we're going to have to be very careful with the bond market and what bonds we own in our portfolio. The second metric we look at when it comes to our penalty flags for defensive preparedness is whether or not major stock market indices like the Nasdaq, for instance, are starting to falter, breaking major levels of support. Believe it or not, April 24th was finally the new Nasdaq all-time high, which has been followed by record highs, as you can see on the chart here. Got a high here, another high here, another one there, and then most recently, another high here. The previous high, believe it or not, was in March of 2000, or over 15 years ago. And again, so far the Nasdaq looks pretty good, but as a quick note, the seasonally weak months for the Nasdaq and tech stocks start this month, actually. So it wouldn't be surprising to see some of these investments struggle a bit within the Nasdaq relative to the rest of the market. The trick, of course, is to evaluate all investments and ensure you're owning those that are top ranked and then benching the ones that start to fatigue and underperform. Here we have a point and figure chart of the S&P 500, which has actually fallen to around 2,080 since I pulled this chart up Wednesday morning. So things are moving quite a bit this summer. Again, we have up here a resumption of a positive trend, which is good, but we also have a trend line break. So we have a lot of temperamental activity going on back and forth. And as I put in the annotation here, the S&P 500 has been range bound for most of 2015, especially since the beginning of the second quarter. Here's a point and figure chart of the Dow Jones Industrial Average. Monday, June 29th was the worst day for the Dow this year, but even before that, the Dow broke its trend line, rebounded, broke it again, rebounded, and so on. It's been extremely temperamental, but remember, the Dow represents only 30 industrial stocks. That's it, which is why I focus more on the S&P 500 and other larger indices when tracking market pulse and health. The third metric we want to look at is sector leadership and how wide or narrow that leadership is. The more sectors that are leading and positive, the healthier the market is. The less sectors showing leadership, or in other words, the leadership is narrowing among individual sectors and industry groups, the more unhealthy the market is. Back in 1998, the percentage of utility stocks on a buy signal reversed down, bottoming in December of 99 below 30% as investors searched for more growth. And this means that less than 30% of stocks in the utility sector back in 99 were on a buy signal, or said another way, over 70% were on a sell signal exhibiting lower lows. After all this happened, everything rolled over and the 2000 to 2002 crash began. What we're seeing today is extremely different. Utilities are in the bottom third, and they've been there for a while. However, the top-ranked industry groups have been and continue to be offensive groups, such as biotech, healthcare, and internet. Banks have been up and down along with interest rates and the U.S. dollar, but they've also creeped up in their rankings a little bit. You can see S&P 500 index funds are sitting at 20, so it's kind of hard to find high relative strength positions exhibiting momentum better than that of the S&P 500. But then you look at money market, which represents cash or safety, and it's ranked 119 out of 133. Taking our sector leadership one step further, if I drill down into all 133 of the industry groups that I'm following, you'll find it interesting to see where money market and worse yet, commodities fall. So we already talked about money market being at the 119th spot, but look down here. At the bottom of the ranking are commodity-related stocks, commodities in general, Latin America, and precious metals, which again are just another commodity. So the fourth penalty flag we pay attention to are what are called percentage trend charts, or PT charts for short. And what we want to be really careful of is whenever these percentage trend charts fall below the 50% level. A penalty flag, as we call it, goes up whenever that chart falls below 50%. And a PT chart measures the percentage of stocks within a group of stocks that are currently trading above their bullish support line in a positive trend. So right now, we just saw a downward reversal take place this week. And if trends across the U.S. stock market continue to weaken, this would be yet another indicator or penalty flag that would suggest danger on the horizon. Right now, we're still above 50%, but we did, like I say, just saw a downward reversal recently. Now, if you're having trouble understanding this or any of the other material in this presentation, be on the lookout for the next video I'm in the process of creating titled technical analysis for beginners, which I hope to have out in the next couple weeks. Meanwhile, stay with me and feel free to rewind this video to go back and listen through the tougher parts again. But at any rate, when it comes to percentage trend charts like this one, if the chart goes up into X's, it means that the percentage of stocks trading in a positive trend is rising. If it's in a column of O's, that means it's declining, and the percentage of stocks trading above their bullish trend line are falling. And again, in this case, we're talking about the NYSE or US stocks, but you can pull up a PT chart for a number of things. The fifth and final penalty flag that we watch for is what's called a bullish percent chart, which again will be easier to explain if we go to the next page and look at the current percentage of stocks in a buy signal on the NYSE. A BP chart for short measures the percentage of stocks that are on a buy signal within a group of stocks. If the chart goes up, it means that the percentage of stocks in a buy signal within the basket is rising. If it's in a column of O's going down, that means it's declining or weakening, and the number of buy signals are going down. Or said another way, the number of lower lows or sell signals are going up. Right now, we've seen lower lows and lower highs since June of 2013. The current value sits right around 47 and still weakening. And you can see 2011's bullish percent dropped all the way down to 18% after the US Treasury downgrade. So there's still potential downside here. Now, with all that said, there's still no reason for panic. A big part of our analysis is combining all these indicators we've been looking at together into an orchestra of sorts. Doesn't make sense to fire the entire symphony just because the trumpets are playing out of tune. You have to look at everything together as one big picture. For instance, even when bullish percents are weakening, but domestic stocks are ranked number 1 or number 2 in our asset class ranking system mentioned earlier, the markets have typically shown us positive returns when characteristics exhibited in these metrics look like they do today. So the million-dollar question, what's the market going to do today? If you've been to our market update pep rallies in the past or any of our other events where I've spoken, you probably know the answer here. They're going to fluctuate, right? The media wants predictions because predictions sell news. But again, I'm not a trend predictor. I'm a trend follower. Market technicians study the markets, charts, volume, historical trends, probabilities. We watch, we observe, and then we adjust our portfolios according to the prevailing weather. If clouds are on the horizon, we're going to want to dial back the risk of it. If it starts to rain, we dial it back even more. When the weather clears up, we can put our players back on the field. But just like we saw in 2002 and call it 2008, no one wants their investments getting hit by lightning and dying. So this type of risk management and active portfolio management is, in my opinion, extremely important, regardless of your age, income, net worth, and or ability to lose money. So let's go over some symptoms, for lack of a better word, that might give us somewhat of a prognosis for the market and what we might expect this last half of 2015. This is a point and figure chart called a HighLow Index. The way it works is we take the total number of stocks that have hit their 52-week highs and then divide that number by the stocks hitting their 52-week high and 52-week lows. Then that number gets plotted on a chart to give us a graph or a trend we can follow. It's a great short-term indicator for the market, and in conjunction with short-term momentum and moving averages, it can provide clues on when to add new cash to your portfolio, let's just say. So when risk levels are low. Whenever the chart's at its bottom or whenever it's low, risk levels are low, and the probability of the market rebounding is higher. Whenever high-low charts are above 70%, let's just say, it might be wise to wait for a pullback before adding money to your portfolio. As the chart above shows, the 10-week indicator reversed up at a relatively low level over this past 2 weeks, which again would mean that risk levels are relatively low. You'll start to see some similarities between these charts I'm showing you here, but this is called an overbought, oversold status chart or OBOS chart. If you picture every stock, index, fund, asset class, anything you could buy, anything you could invest in having its own bell curve, where 0 is the middle of the bell curve, you can start to see how this works. What you're looking at right now is an OBOS chart of the SP 500 index funds. You can see that way back in May of 2014 that the market was very overbought, which means that risk levels are high for a pullback or correction. Conversely, you can fast forward to October of 2014 and you can see that the market was extremely oversold, which means that risk levels were very low and poised for a rebound. By the way, this time period back in October was also when the market dropped by almost 10% in 45 days. And today you can see that we are pretty evenly distributed on our metaphorical bell curve here, which means that this would typically be a good time to add money to your portfolio. However, there are other issues on the horizon, which we'll discuss in a second. And again, you can never look at one indicator such as this one and make any investment decision by looking at one chart. Some of the concerns we always hear at our office have to do with the probability of another market crash. The good news is we spend every day watching the markets and preparing for just that. The other good news is I don't see an imminent market crash around the corner. And when I say around the corner, I mean I don't see one in the next few months. So let's talk about what the market looked like back in 2000 before it fell 47% from top to bottom. You can see here when we look at the prior years before 2000, we had this big dip in the 50-day moving average, which crossed below the red line, which represents the 200-day moving average. And then you can see as time went on here, it came down and almost kissed it in November of 99 before March of 2000 when the market really started to crash. Now let's look at the market prior to 2007, right before it fell 57% from top to bottom. Here you can see that, again, the 50-day moving average fell below the 200-day. Then it kissed the line again here, kissed it again almost, dropped below it here in 2006, seemed to make its way all the way up north here until towards the end, call it middle of 2007, when things started to really roll over. And again, the market ended up crashing and falling to the tune of 57% until March of 2009. So now let's look at the market today. So this is the S&P 500. Are there some similarities? Yeah, one or two, but that's it. So do I think a correction is imminent? I do. But the market is supposed to correct. The market goes through an average of 10% corrections. So basically the market goes down on average 10% once every year. But we haven't seen one of these corrections since the summer of 2012. However, this also isn't the first stretch of positivity we've seen. Back in the 90s, there was actually a 6-year period where the market never experienced a single 10% correction in 6 years. So is there danger on the horizon is the question mark here, right? A little, but nothing catastrophic. Looking at this very, very interesting chart on your screen, you'll see that the average price tendency is for a summer sell-off that usually begins in mid-July and lasts until about mid-October. Part of this reason is maybe due to the fact that July starts the worst 4 months of the year for the Nasdaq, like I mentioned earlier. It also falls in the middle of the worst 6 months for the Dow and the S&P 500, in other words, the seasonally poor months of the year. Mid-July also happens to be the start of earnings season, which is already upon us, where we can start to see previous week's market action start to take a breather, as active traders may have maybe bought the rumor and bought ahead of anticipation of good earnings expectations, and then ended up selling the fact once the bad news hits the street. This is all assuming that news is bad, or at least less than expectations, of course. But anyway, the big issue here is, again, a healthy, albeit not so great problem to have, is when we're looking at 2-term election cycles where presidents have spent 2 full terms in office. The average loss in October amounts to a whopping negative 9% in these 7th years. And that's just the average. So that means that half are better and half are worse. With that said, if we go back to 1833, there have been 45 complete 4-year cycles, excluding the current one. Over those 180 years, the Dow Jones performed best in pre-election years, which is where we are now, with an average gain of 10.4%. The second best performance was in election years, gaining an average of 5.8%, and the worst was in post-election years, gaining just 1.9%. So I'm not trying to be wishy-washy here. The point is, we need to know our history, know our averages, understand seasonality, and watch for clues of that correction, or worse yet, a crash that could be in front of us. Either this year's market performance will act like the typical 4-year pre-election cycle, or it's going to act like the 7-year, and I'll be watching for clues so that we can adjust accordingly, of course. Speaking of market seasonality, while I update this data each year in May and November, I thought it would be fun to include it in this first ever halftime video. The numbers are absolutely stunning, and what's even more interesting is that the trends never change. If you were to invest $10,000 in May 1st back in 1950, and then you sold out of the Dow on October 31st, and you did that every single year, invest $10,000 in May, take the proceeds October 31st, go to cash for 6 months, invest what's left over in May, sell in October, and over and over again, your $10,000 is worth $9,773, or in other words, a loss of $227. Where things get crazy, and again, you can see the punchline here, is if you did the same exact thing, except you invested that same $10,000 on November 1st, 1950, sold out on April 30th of 1951, and then went to cash for the summer, again invested on November 1st till April 30th the next year, and so on and so forth, your same $10,000 is worth $848,167. Crazy. With all that said, seasonality is just an indicator that tells us the historical tendencies over a period of time. It's also just an indicator that comes secondary to price. In other words, the trend trumps seasonal tendencies. The power comes when the trend and the seasonal tendencies align, and that's what you have to look for. Another piece of good news, consumer staples and healthcare, which includes pharmaceuticals, biotech, and genomics, which, by the way, we've been overweighted in for almost 2 years now, all tend to outperform through the worst 6 months of the year. So not all is bad during the seasonally weak time period for the U.S. market either, in case you came to that conclusion. Now, with all that said, it's important to understand that we're not trying to avoid every tiny little dip in the market. Would it be nice to catch all the gains and miss all the downside? Of course. But that's not how this works, of course, and you know that. So what we want to do is we want to miss the big ones, the crashes. If we lose 8% of your money, then our break even, in other words, we need to earn 8.7% to get back to even. If we lose 20%, we need to make 25% to get back where we started. If we lose 30%, we need to earn 43% to get back to even. 40%, so if we're down 40%, kind of like we were in 2008, the break even is 67%, and in most of you have probably seen this last statistic. If you lose 50% of your money, you have to make 100% to get back to even. So again, we're not trying to miss every little pullback or breather in the market. What we're trying to miss are the big ones. With all that said, the main concept we want to take away from all this is to understand that making a profit isn't enough. You have to keep that profit. And the only way to keep a profit is to take it off the table. When financial advisors are trained in this industry, they're told to tell our clients that when the market crashes, don't worry, just stick with it, buy and hold, it'll come back. You haven't lost anything unless you sell it. This couldn't be further from the truth. And the truth is you haven't made anything unless you sell it. Probably the best way to explain to you how we and other fee-only technical analysts manage money is to tell you what we don't do. So we will not buy at the bottom and sell at the top. That's impossible. That's market timing. This would assume that we have some crystal ball somewhere in the office that tells us what the market's going to do tomorrow. The truth is the market shows signs of weakness, days, weeks, sometimes months ahead of market crashes. So what we do is when the market crashes, we'll always miss some of the gains on the way up the hill. And then when the market starts to peak, we'll start tightening our trapeze nets on the investments we own so as to sell them as they hit our exit points, eventually getting out of the market on the way down the hill. But again, we can't and won't get out of the market at the top. And it's not like we jump in and jump out the next day. It's a dimmer switch, not an on-off switch. We'll buy pretty aggressively on the way up the hill, and we'll want to capture most of the upside. Then when the market begins to show signs of weakness, we'll sell on the way down the hill, aiming to miss most of the downside. There is no perfect strategy, no silver bullet, but we think that the evidence points to buy and hold being an old, outdated strategy reserved only for people who are rich enough to have the leisure of affording another 50% loss in their portfolio. And I'll get complaints from skeptics, but the simplest way of summing all this up is to buy the winners, have an exit strategy, and sell the losers, then go buy more winners. I know it sounds simple, but it's not easy, but it is simple. If you're a college football fan, you'll remember Ohio State's team last year and all the noise that took place in the press after they lost one of their first games to Virginia Tech. The problem was, for non-Ohio State fans, they kept winning. Even with all the noise in the media about losing 2 quarterbacks, Heisman hopes fizzling away, and a brand new wet-behind-the-ears rookie coming into play against a couple of the best teams in the country in the NCAA playoffs, they still kept winning. Bringing this analogy back to investing, even if Ohio State would have lost in the playoffs, the great thing is we don't just invest in Ohio State. We don't just invest in one team or one investment. We invest in the other highly ranked teams as well, like Alabama, Oregon, and so etc. So the point here again is there is no silver bullet indicator, chart, or metric that we can follow in order to guarantee results. Nobody can do that. Just like there's no guaranteed winner each year at the beginning of any football, baseball, soccer, tennis, or golf season. You have to follow the trends and let those trends be your friend. And when the strong investments start to lose games, then we're again fair weather fans, and we'll go jump on someone else's bandwagon. Managing money is a lot like flying a plane. I like to use this analogy because sometimes you'll get turbulent storms, sometimes you'll fly at night during these occurrences, and you always have to follow your indicators, your instruments. You need to have confidence to win and to lose, and then you need to have the confidence to fail, but fail fast. It's okay to be wrong, you just can't stay wrong. So please share this video with your coworkers, friends, family. It's free, and while we're biased, of course, I think it's good information. We are a fee-only RIA firm, so if you do have interest in interviewing us and getting a second opinion on your portfolio and a retirement plan with the possibility of working together, that you don't have to worry about the conflicts of interest that arise between fee-based firms and the clients who work with them. Fee-based firms can charge a flat fee or percentage of assets like we do, but they can also charge commissions on mutual funds, annuities, insurance, and 401k plans. We legally, as a fee-only firm, cannot accept any kind of commissions or kickbacks, and we operate under a fiduciary standard where decisions we make must be in our clients' best interests, even if those decisions result in less money for our firm. Most people can't afford to, or at least they don't want to experience another parabolic drop in their portfolio, like the one we observed from 2000 to 2002 or 2007 through 2009. Get educated, stay informed, and if we're not the right firm for you, that's okay. Just find a qualified fee-only RIA firm that implements a form of technical analysis so that you know that your portfolio isn't being ignored with a set-it-and-forget-it rebalancing approach. There are disclosures at the end of this video. Please read them, but above all, none of the information contained in this video should be taken as investment advice or a recommendation to buy any investment at any time. Opinions are subject to change without notice at any time, and market prices do change minute by minute. So please do not make any investment decisions using the information in this video without speaking first to a qualified investment professional. You are responsible for any actions you take as a result of any of the information in this video. Please contact us online at libertaswealth.com. You can follow us on Twitter at libertaswm. You can follow me on Twitter at Adam Koos. Check us out on Facebook. We kind of leave intermittent charts and graphs and commentary from time to time, as well as articles we're published in nationally there as well. And of course, if you'd like to see more videos like this one or others, you can find us on YouTube by searching for Libertas Wealth. Thank you so much for watching today, and I'll look forward to seeing you next time.